doing a time check. We're a little bit behind time, so we may make some adjustments as we go throughout the day. But come on up, Margot. We're going to go right to your item. This is an action item. Margot Worth and Rob Ross from Private Equity. This is a policy revision. It's action, and there's an accompanying letter from our consultant, John Haggerty, Stephen Hart, and Hannah Schreiner. You here as well? Come on up, because you have an accompanying letter to this item, which is after INV 200 is the Makita letter to us regarding this item. Margot?
Thank you, Harry. Sorry, Margo, before you jump in, I just, I'm asking, I know it's an action item, I'm asking that we consider this a first reading. We're realizing we have some challenges with the last policy updates you implemented, and I want to make sure those get all implemented. We want you to review this and read it and get your input, but then we'll bring it back on the consent calendar in September for final adoption. So I don't feel the need to adopt it in this first reading.
Okay, that's what we'll do then. Thank you. Margot?
Thank you. Margot Worth, I'm the Director of Private Equity. Rob Ross is one of our 5 portfolio managers. For members who weren't here last year, we did a major round of revisions to our policy last year. It had been a decade and it was quite out of date. This is some more fine tuning with one exception, and the exception is that the format, the physical look of the policy is changed, and this is part of a branch-wide, investment branch-wide initiative to standardize the policy look. Rather than a red line, because many sections were changed in order and things moved around, a normal red line didn't seem to work well, so we made up our own, instead of red line, red, blue, green, and yellow line document. And I think we neglected to put this page in the agenda item. So this is the key that you need to understand what all those rainbow of colors mean in our marked up policy.
The good thing is you'll see that regularly now. So every policy, including the investment policy management plan that I'll bring back in September, will have that key, and we'll try to show you what is just moving language and then what's new. So I think I tried to emphasize blue underline and red cross out are the real big changes. The rest is all just moving the deck chairs.
Yeah, and Rob has just informed me that we actually do have the key. It's on INV 184. So I guess it just wasn't in the presentation. Here's an outline of the things that we want to change in the policy. We just covered item number 1. I'm going to cover item number 2 and 3 together and spend just 2 or 3 minutes on each item. Items 2 and 3 deal with a new sub-asset class and a new hierarchy to the portfolio. So we have a hierarchy to the portfolio. You'll see what I mean with this slide. And we also have a hierarchy to the benchmarks. This is our current hierarchy as indicated in our current policy. We have 5 sub-asset classes listed there in this chart. We have, since last year, we also adopted a 6th sub-asset class. It was formerly called TAC Ops. This is small, relatively small. It's $200 million or 1% of our portfolio. And this came over from Steve Tong's group, the Innovations Group, where they've incubated a new strategy. It did work out well. When we looked for a permanent home, it was thought that private equity made the most sense. And so this is what we actually have right now. And with everything else going on, it was not particularly material. Like I say, that opportunistic multi-strategy shown there on the right is 1% of our portfolio. So we could have come here today and asked you to essentially codify what we're already doing and make sure you're okay with it. But since we are changing it, we decided to look deeper. And you know, this structure is 99% on the left, 1% on the right. And what we're going to suggest instead of this actually is this. And we think this is a better way to look at the portfolio and analyze the portfolio. What we've done here is we've added 2 subgroups. You see the traditional and the opportunistic. This is not an uncommon practice in the industry or even within our own portfolio. And so we have the 6 sub-asset classes, but we now have these sub-asset groups. And what we've tried to, the rationale for this layout is, on the left, we have traditional private equity. This is what we've been doing for 30 years. This is that partnership investing that I was talking about earlier. There's a lot of other programs that do this. There's a lot of data. When we do our benchmark on this, we can get reasonably good for private assets, reasonably good peer benchmarks. So it kind of almost mirrors the, or is similar to what you have in the public assets where you know what the universe is, and we can see how we do against the universe. What we've done on the right is we've put sub-assets that are less traditional. There hasn't been a 30-year track record, and we really can't get data on how these sub-assets perform. We can't look at the universe, and so we tend to use on the right what we would call a proxy benchmark. And so, for instance, on the multi-strategy, we're using a benchmark that is a blend of a hedge fund index and a public market index and a credit index and a stock index. Thanks, Rob. And let me see here. What this shows is that it's more bounced. It's not. We're not doing it just for bounce. We're doing it because of the characteristics, similar characteristics. These percentages represent the targets, and as you can see, we still have 87% in the traditional, our bread and butter type of investing. But as the industry changes, more would tend to go to the right. And so that's the structure we are putting forth in this policy change. Let me see. The third thing on our list was the special mandates section. I don't have a slide for that. I'm sorry, the fourth thing was the special mandates section. We had never updated that part of the section last year because it was still in flux as to how special mandates were going to be handled. So that's just essentially written to be more informative. It talks about the 3 special mandates that we have within private equity. That would be the underserved. That would be the new and next gen, sometimes referred to as emerging managers, and that would be the clean tech. So you can read that in the policy. I would say it's just a better description is the only thing, is the main thing that changed there. That brings us to the final item. These are technical updates. I don't think any of these in and of themselves is particularly substantive. I'm not going to, in light of the time, go through any of these unless there's a request to, with the exception of our allocation table, which will change with the addition of that new sub-asset class. So because we're going from 5 to 6 sub-asset classes, we have to make room for it. And it is only 1% now, but long term, we think we should put a 4% number on there. And so what you can see here is that we have added the 4% to the multi-strat, and I think the wrong lines are maybe highlighted there. Multi-strat has gone up 4%, and debt-related has gone down 4%. Multi-strat does have a debt-related element, and we think that would make the most sense of where to make room to shoehorn that sub-asset class in. And with that, we will be glad to take any questions.
Marco, if I can jump into, I would draw the board's attention to the longer-term strategies. We've debated whether to call that core. We finally decided on longer-term strategies. It's still at the early stages. We only have a few investments there, but I am really starting to see a big shift in that area. And the best way I can describe it for those they're on the CalPERS board and read a lot about what PERS is doing. PERS has talked about creating a separate board and company to invest. They call it opportunistic, but to them it's to invest like Warren Buffett, which I think great. That'll be awesome. I'm not sure you're going to be able to copy him, but good luck to them. That is my pension. To us, we see this more as sort of buy and hold kind of private equity. Instead of trying to hold a company for just 5 to 7 years and then sell it, buy and hold it for maybe 10 to 20 years. And we think that makes a lot of sense. I'm seeing very large firms step into this space because obviously huge amounts of capital. We are seeing this on the other side of the ocean, obviously, in Asia with SoftBank wanting to raise $100 billion funds to buy companies. We think it's going to be a real interesting area. It's going to have a different return profile than traditional private equity because not as much leverage, but it actually fits our liabilities better, and then it's a much longer holding period. So right now it's small, 2% interim, maybe 5%, but I would not be surprised if we see that as a real size opportunity to grow the entire private equity portfolio, and that is a slice of it.
Thanks, Chris. Before we go to questions, comments from the committee members, John, Steve, you want to comment beyond what your written comments were? It was a good write-up, a nice summary of complicated policy.
A couple of things just to comment. I think one just been described that a number of asset classes, and especially private equity, is a dynamic asset class. There's different types of strategies and approaches that come to market, and they should be reviewed and thought about and potentially included in the portfolios. So, the longer term and the multi-strategy class are ones kind of representing that, and to include them as a set of opportunities to widen the scope and to make a broadest set of opportunities for the staff to be able to approach and to consider in the portfolios makes a lot of sense to us. I think one thing that, 2 items that we wanted to be thoughtful about with those 2 strategies is understanding how the risk-reward profile of those investments kind of looks like. How the staff would be choosing what looks like an attractive risk-reward profile to go into those, how they get defined as compared to other particular strategies. And then that would also be reflected in what the benchmarks are for those particular strategies. And we do note that the strategy, the multi-strategy, the investment that came over from that has a different kind of benchmark. It's a proxy-based benchmark as opposed to a peer-based benchmark, and that has implications for how the overall private equity asset class benchmark would be reported and codified. So we identified a couple of those issues and recommend continued thought about those topics.
Right.
Thank you. I submitted a number of questions ahead of time to you. Mostly they were questions having to do with internal consistency of the document. Did you get those, and will you be addressing those in future revisions?
We received comments from both you, Frank, and Karen. Thank you very much, and those will be incorporated when we come back with the other document. We thought those were pretty straightforward improvements that.
On IND 163 and the program objectives, document states that private equity investment opportunities have advantageous corporate governance structures. What exactly does that mean? The program objectives first paragraph.
So in some ways, a private structure can be where you are essentially owner-operators and you don't have a diversity, a board of outside consultants. I mean, there's pros and cons, but an advantage of being owned by a private equity firm is there can be one unified vision and one decision maker, a group, but one firm, and things can move very, very quickly. And so if a company has to be revamped or sold or combined, Usually a private equity corporate governance structure is going to have the edge. They can just move quicker and get the job done.
Okay.
And it's kind of a professional ownership
Yep.
experience.
Yep. On INB 165, the opportunistic sub-asset class, the benchmarks there, those are all proxy benchmarks, aren't they? All three of those?
Well, little clarification on the right, on the left, they are all peer-based. On the right, multi-strat is proxy. The long-term and the special mandate are currently peer-based, but we think that those should probably be changed to a proxy. And to the extent that we are still using a peer-based, really the peer-based really in some senses is a proxy because the benchmarks we invest in do not have the characteristics of those.
So you would like to change them at a future point in time?
That's right.
When would that be?
Coming year.
Okay.
Coming year.
A couple more questions. INB 169, the side-by-side investments that are mentioned on that page.
Sure. So what we noticed there, why there's added language,
Right,
and
exactly.
Rob, you might help me out here, is that we did not have, when we did our major overwrite, we neglected or somehow deleted a limit there. So in going back through this, we thought there really should be a limit on the size of these side-by-side investments.
And we decided to scale up to be able to do larger, consistent with our programs being larger. So that's why the number went to 100 million for both new and follow-on.
Okay. I think that was it for now. Thank you.
Okay.
Paul?
Thank you. So my question is on page INV 187. I guess this is the clean copy here. So the benchmark for periods of less than 10 years is a dynamically weighted blend of the benchmarks for traditional and opportunistic. So what do we mean by dynamically weighted?
I think that's a term of art that we use other places in CalSTRS. To me, that means that if the portfolio looked like in this chart, for instance, on an actual basis, and here, and I think this ties into the point Steve Hart was raising. On the left side, we have we would come to a benchmark and a performance number for traditional. We would come to one for opportunistic. On the left, they might be IRR and time-weighted based. On the right, they may only be time-weighted based. But when you go to blend them, you would just say, 87%. You would just blend the performance and blend the benchmarks in the proportion of 87 and 13.
But 87 and 13 aren't in our policy, right?
Well,
where do 87 and 13
by the
come?
word dynamic, it would imply that whatever the actual allocation was.
Okay, so
So
this
on
is
the left side, we would still use the interim target weighted that we discussed last year,
Right.
that we would, the benchmark would be calculated based on the targets, not the actual. But when it rolled up to the top, those traditional and opportunistic would be weighted according to the actual NAVs.
But it's your decision how to allocate our investments between traditional and opportunistic, right? I mean, if you decided to invest 85-15, that's a staff decision, not a board policy.
Well, in a sense, it's not, because the board sets those 6 numbers across the bottom. And so we would have a target. We could be off target, but I think with private assets, you got to remember that we can't sell. It takes, 4 years to approach a target, and it's very hard to predict. But there certainly would remain the governance on the 87% of the portfolio, where if we were far off of our target, our benchmark would reflect the target and not the actual, which was the change we made last year at your request. But
Right.
so that would.
When I see dynamically weighted, then it seems to me to potentially go away from
I would say
the change that we made.
it could potentially dilute that effect to the extent of the other 13%. But for 87% of the portfolio, we would still have that dynamic that we set up last year.
But what I'm saying is we want, to the extent we're using a benchmark to measure the performance of staff relative to what staff could do within our policy. We don't want a benchmark that says what you should be getting in returns is the returns that you get from what you invest in. It should be what you should get as returns should be what the universe of what you can invest in is.
Well,
So
I
hold on
think
a second,
things.
hold on a
Sorry.
second, Mark. Go ahead, finish your question, Paul.
Sorry.
And then I'm going to ask if Steve or John Haggerty can
That's what I
help
wanted to do.
try to answer Paul's question.
I mean,
Seems-
it's for, if this sounds a little esoteric, it would be like saying, we're giving somebody some money to invest in the public equity market. They can invest in the S&P, any stocks in the S&P 500, and their benchmark, therefore, is the S&P 500, because that's the universe of what they can invest in. And they invest in 10 stocks, and those 10 stocks underperform the S&P 500. We wouldn't say, well, now their benchmark was the performance of those 10 stocks, and therefore they met their benchmark. We would say their benchmark is the universe of what they could have invested in and what that yield was. And if they invested in 10 stocks that didn't meet the benchmark, we would say, well, then they didn't meet the benchmark. So what I keep seeing and having a problem with when we talk about the benchmarks for our private asset classes is that we tend to move in the direction of defining the benchmark as what we actually decide to invest in, as opposed to the universe of what we can invest in. And that was the conversation we had last year, where we tried to, flesh that out a little bit. And that's the concern I have again with seeing this terminology of dynamic, because it seems to me that we can then use it to say the benchmark is whatever we decide to invest in, and therefore automatically we meet the benchmark.
Okay, so I think Paul's making an important point. It's very nuanced for me. It's probably nuanced for some people around the dais to try to address as a collective group in a public session on a very constrained. If we had all day to talk about this one point, we could. What I want to do is ask our consultants to succinctly help us understand. We're not taking action today. On the feedback that Paul and the questions that Paul have raised, to the extent there's consistency and legitimacy, and I think there is when this item comes back, have that addressed for us.
So Paul speaks to an age-old, you could call it a philosophical question about benchmarking, which gets to what question you're trying to answer. And the more specific you make the benchmark, there's certain questions that it's not answering. So when it's very broad, it answers the question, how are you doing relative to some understanding of a broad private equity universe? That's question one. Some modifications have already been made for a lot of very good reasons that take out two other answers that you can get, which is what is the effect of vintage year deployment? And the other was, what is the effect of selection of broad categories that the staff can make, like venture, buyout, and debt? If it were to get more specific, and we don't know the direction of potential changes for the opportunistic side of this, it would go another degree in the direction of answering a different question and isolating selection effect, that is the individual selection skill within each of these categories, rather than the postmortem of the wisdom of having been X% in these categories. So it's a matter of degree, and there's a spectrum, and that's the best that I can say to put the issue in a nutshell. But it's a common discussion to have, and I think it's a legitimate question to be asking. If the benchmarking does get more specific from here, and we don't know if it will.
I'd say that, in the discussions with staff and with State Street, the topic that you're talking about, Paul, is, I think, clearly reflected in the investment policy, the benchmarking there. And there is work to reflect the benchmark, to have that benchmark reflect what that those topics are. In other words, that when the policy says that there are interim targets in particular strategies, that is what gets reflected in the benchmark process. I think what Margot is saying is that some of these opportunistic strategies, as they're developing and things, that there's some additional thought that's kind of going through to help get those particular sub-strategies into the benchmark in a way that's effective. It's pretty small now. These particular ones are relatively small parts. The biggest one is the special mandates, currently at about 7%, which still has a peer benchmark on it. But these other benchmarks for longer-term strategies, multi-strategy, those are being formed and kind of being figured out. But I'm just saying that the intention that you're having is reflected in the policy and the work that's being done by staff and State Street to get that effectively reflected in the benchmark is taking place.
Okay, I might want to follow up with the two of you because I'm still confused and not sure that we're doing this the way that it makes sense from the standpoint of why we want benchmarks, but let me follow up.
I think that would be helpful, and I appreciate, Paul, you understanding the time constraints we're working on and the nuances. Clearly, there's some, as John said, there's some legitimacy to the questioning that you have, and I think it would be most helpful for the group collectively for you to speak with Paul directly, get some of that ironed out so that when it comes back, there's a higher level of confidence and security around the specific issue, the benchmarks, how it's being measured that Paul is raising. I'm glad we're not asking to take action on this today. It gives opportunity for people to flesh this out a little bit further. I think the point that Chris made was that asset class, that potential growth going forward. For me, that's kind of where I'm focusing in on. Not to say the line of discussion is not important; it's critically important. But I think there's an indicator that was pointed out to us for us to keep an eye on. Anyone else with questions on this? All right, so this can come back in September. All right. Thank you, Margot. Thanks, Rob. Thanks, John. Thanks, Stephen. Chris, CIO report.
Thank you, Harry. First thing I want to say to the committee is this is going to go a tad longer than the time expected on the agenda. I apologize, but there are 7 things I need to get through. Some stuff got added to it. So please bear with me. A lot of information to share. The first thing I want to say to you and to the audience, at the May meeting, during the public comment, I think I let the moment get to me. It was a long meeting. The labor issues at the Pullman Hotel really had me at my wit's end. We feel your frustration. We empathize with the employees and the workers, and we understand the challenges everybody is facing. And I personally want to apologize to you because I let my level of emotion and frustration show. My comments to the audience, my comments weren't to disparage anyone, and I'm sorry if they did. So I apologize to you, the board, to our members, and to the public. Frankly, I expect better of myself, and I expect better of our staff, and I know you expect better of us. So we will do better and work on that. We're also human beings, so I realize that. Second off, big news. I'm going to ask, who's got a free seat? Glenn, you're at the far end. I'm going to pick on you. Well, you ran a marathon once. You got to be in shape, right? Yes, once. What can I do? Pass those out to the board if you would. Hey, fiscal year in performance. Is the press release out?
We will be after you say this.
I guess I'm going to say it. Better get it right. I'm passing out to the board our June 30 performance. So to the teachers in the back of the room. June 30, our official net return, thank you. Our official net return for the year was 8.96. So in the press release, that'll get rounded up to 9%. So 8.96 net. More importantly, I think, is our 3-year number, which was 7.8 net. So we beat the actuarial assumed rate, not the required rate, as Paul mentioned. We beat the actuarial assumed rate. We did beat the benchmark over 3 years by about a good 30, I think, almost 40 basis points. And we beat funds that happen to reside here in California. Let me put it this way, we beat my pension plan. This report that I'm passing out to the board, it'll be in the September agenda for everybody. This is just kind of a cheat sheet for the board to be able to see where the returns are, because I know you get members from the public. Over 10 years, we struggle. We're up 6.3%. And that really has to do with the fact that these 10 years, 2018, you go back and you pick up 2008, 2009. So that was an extremely negative year. As you can see, it'll drop off that 10-year number. But I'm pleased to say that over 30 years, I think our net return is about 8.4. So exceeds our actuarial assumptions over those 30 years. Our 10-year is a bit below pace, but our 5-year at 9.1, our 3-year at 7.8, and our most recent year at 9, all ahead of our actuarially assumed rates. So when I always use the marathon example, we're ahead of the pace per mile. And I'm pleased to say all of those numbers are also higher than the return of my pension plan. So good for the teachers. I'm wondering if the actuary is going to do a wave, but we have a big crowd, so I'll move on. I think over 20 years, I wanted to highlight 20 years is an interesting time period. Our return is 6.5. And you can compare that to my pension plan at 6.1, so pretty dramatic. That's over $1.2 billion of added value over 20 years that the teachers have gotten, which is I'm very proud of, and I'm very proud of our team. On ESG risks, I wanted to highlight, obviously we have seen a lot in the news. I expect we'll hear a lot later this afternoon from the members, and we have received letters from the members with concerns. Private prisons have been a constant discussion. Ted and I have discussed it. I've discussed it with Jagdeep at UC Regents. Regents decided to divest of those. Under our ESG policy, I have the ability to take something I think is a risk to the portfolio and say, let's initiate it under that review. So I am taking the private prison companies and initiating them under review of our divestment policy for the risk factor of respect for human rights. I'll email that risk factor to you so you read it. It's complex. It's mostly, frankly, written for countries, not individual companies. So, but what that means, basically, we've been engaging with the private prison companies for a while. This means we're going to just contribute more resources. We'll step it up a notch and travel directly and engage them directly. And talk to them. There are 2 other companies that I'm concerned about. I won't initiate them at this point because we can't verify that there's a direct connection. It's a social media connection, which may or may not be accurate. So we're going to look into that. Now, to get into my slides, and I will go through this. So at June 30, our actual assets are 223.8. I know Loretta and several of the newsletter writers in the back of the room need that number, hence my emphasis. So basically 224 billion at the end. You can see the graph for the year. We started the year at 208. remember, we have a negative cash flow of almost $6 billion a year that goes out the door. We did hit our high for the year in mid-January, late January, so that was the high, and we've traded sideways here during the rest of the fiscal year. Here's our asset mix as allocated at June 29, the last day of the year. You can see as allocated, spot on the portfolio. We'll be talking to the board in greater length in closed session about how it's invested as invested compared to as allocated, which is a nuanced difference between the portfolio. But most of our year, we really, as you know, spent time really close to the targets, not taking a lot of outsized risk on the aggressive side or the defensive side in the portfolio. So here's a quick snapshot of last fiscal year. Just kind of pay attention to the shape of that graph. As you can see, the first half of the year, from July to January, a huge climb up. And notice the steepness of that climb at the last month of that time period. I'm a geek. I'm a big fan of the Tour de France. So to me, that's like an Alpe d'Huez kind of climb. That was yesterday's tour, anybody that watches it. And very hard to keep pace with that. So here's the time period since then. Very sideways. It's considered a flag pennant pattern, but the market has continued to trade. It was up, the USA was up almost 15% on the year, so a real positive year for those that have 403Bs and 401Ks. If you had equities, you did okay. Here's the US market. So there's the US market on the year. Here's the non-US market. Very similar shape, but not as dramatic of a rise. The scale changes a whole bunch. So the non-US market was only up about 7.3% on the fiscal year. And notice the drop in January, much more pronounced. And this market has really been hampered by all the trade talk and Brexit and the European worries. Here's the USA over the past 3 years, which is what the actuaries this morning, this is what they really care about. The beginning of the 3-year period in 2015, pretty sideways, and then this big run up, and now this sideways period at the top. But up double digits over the last 3 years. That's what really helps our funding. Non-US over the last 3 years, a longer flat period, went from 15 to all of 16, and only about 5%. So, you know, we talk a lot about the fact that we've gone global. During almost all this period, we had a home country bias, which, as you can see now, paid off handsomely. And that's going to be something that we're going to have to debate all the time. The fact, you know, a 3-year period to have non-US stocks have twice or half the return of US was really a dramatic time period and very tough. I want to spend a little bit more time on this chart. This is interest rates. So in a simple terms, you're looking at 3 months all the way out to 30 years. The light blue is where it was last June. The dark blue, black, is where it was this June. So you can see that short-term rates shifted up. Elizabeth yesterday was mentioning how that's part of the Fed tightening. That's what they can control, is that very short end of the curve. The concern I want to highlight is that line I'm adding. Look how flat the curve is. You're going to hear the phrase 2 to 10s. 2 to 30s, 10s to 30s, those are all bond yield terms that really say basically the yield curve is very flat, that spread is very narrow. And I don't want to, I guess, I don't know if you guys hear this a lot or not. Karen, I'll look to you if this is something you listen to regularly. Historically, when the yield curve goes flat, people get worried because if it goes inverted, it has almost, I think it's always been followed within about 15 months by a recession. So there's still the debate about correlation versus causation. It doesn't mean the minute it goes negative, 15 months later, we're going to have a recession. But it is a long-term signal that has repeated over and over, and that's what we're going to watch. I'm going to probably regret saying this, but we have said many times, it's the bond market people that are the smart people on the street. It's the bond market people that don't have good hearing. but equities tend to look out 6 months, bonds tend to look out even longer. And I think we really have to take our clue this time from the bond market. You heard that collective groan from the staff behind me, because now we'll have to live that for a long time. So market scoreboard on the year. Those are the numbers again. Look at the fixed income market, a real challenging year. Credit's going to go to Glenn Hosokawa and the team again, because they squeaked out a positive return last year. Not a lot, but a positive return, even though the market had a negative result. So looking out of the horizon, what are the things we worry about? These trade wars, these tweets. There was another tweet today. I heard somebody describe it that from China's perspective, this is a trade battle, but not a trade war. The concern is if China starts to view this as a trade war. Their last response to the tweets was to ask the World Trade Organization, WTO, to look into this. But if they start retaliating even more, then this really, as you're seeing in the papers, this could really disrupt any positive news in the market. The market's having a positive bias still because of the tax cuts and corporate earnings, but that can all get wiped out. All the rest of these risks still exhibit. The last two I've added that are new, which I thought were very poignant. Harry and I were at a conference where somebody emphasized, we were outside the USA, and they emphasized the one thing the USA is exporting right now is uncertainty around the world. We used to be the big stable giant in the room. Now we're acting kind of, I'll say, crazy. And the other thing is, I've heard this from a couple of very major CEOs, which is surprising, the anti-made in America sentiment. You haven't seen people in China smashing their iPhones or burning their Ford cars, but there is a growing sentiment around the world to shift away from the USA and shift to China or shift to home country. And CEOs, serious large company CEOs, are genuinely concerned this may be a continued growing sentiment and not disappear. So there again, something we have to watch. On the positives, you heard it yesterday from Elizabeth, slow, steady growth in the USA. I whispered out loud to Deborah Smith when she said her numbers, it was like, we're back to Goldilocks. Not too hot, not too cold, probably just right. But I have to tell you, I just see such a growing discontent. And Sharon, you hit it on the head, which is every time the Fed says we're at full employment, wages are rising. And everybody I talk to says, I don't feel like we're at full employment. I don't feel like the wages, and it's really spotty. There was an article today about, the unemployment is non-existent for trained people in Texas, and that they are advertising $100,000 jobs for trained people. I have to think there's lots of unemployed in Texas. They're just not those, quote, trained people. So, looking at history, to me, this literally feels like the 1960s. I know we don't have the Vietnam War. I know we don't have college riots, but boy, the discontent in this country is palatable. And I don't know how that ends, but it's usually not positive. And the stock market does feel a little bit like the 60s. The go-go 60s were a good time, but that set us into the 1970s with stagflation and a lot of problems. So last up I want to highlight is that investment information is available, and I will run quickly. There are 3 pages I want to highlight in the CIO report. If you would turn to INV 205. At the bottom of that chart, those asset classes have traditionally been very, very stable. But you really see at the top, and I know I have a hard time seeing it because they're all green-ish shades. But the very top of that chart, RMS is growing as a huge asset class for the first time, and you can see the change in that. I also wanted to point out INV 206. Josh Diedish and his team that runs the risk did a very clever job of these pie charts. So clever, I have a hard time reading them properly. But what he is trying to show you is the disk inside the bigger disk is to show you how we're invested from a risk standpoint. And I don't want us to lose track of our risk factors. We pay attention a lot to the asset allocation, but from a risk perspective, we are still about 75% exposed to what I'll call GDP risk, global domestic or gross domestic product risk. And we need to be aware of that. Even though we're diversified, we need the economy to keep hanging in there. And then lastly, I'm going to turn you to PCA's chart, INV 213. I would note at the very bottom, the chart has gone to neutral, gray. This is, as Alan pointed out, the second month after this prolonged period. Alan would be the first to tell you that's not a trade indicator that you want to jump on, but it is something you need to be very aware of, particularly the flat yield curve, which has gone red, and bond spreads and equity spreads are disagreeing now. So it is something we need to watch closely and be concerned about. And lastly, thank you for your indulgence. I would like to introduce our summer interns. These are our students that we're able to put together as a cohort. We have a group of students that are the green cohort because they come from the CSU schools, so they start earlier in the year. Go ahead and line up, guys. There we go. And we have a blue cohort that's more the UC system because they don't get out until late June. But these students work for us in the summer. They earn enough hours to be able to qualify for the investment officer exam. So if and when they graduate and they choose to apply, they can come back and apply for a job. And I've asked them to take the moment, if you would, to introduce themselves. So, Eric, start us off.
Hello, everyone. My name is Eric Gutierrez. I am a student in Sacramento State University. I'm a rising senior now. I'm majoring in economics with a minor in business administration. And I would definitely love to come back to CalSTRS as an investment officer one.
Hello, everyone. My name is Nicole Yamamoto. I'm a recent graduate from Sacramento State University with a bachelor's in business finance, and I as well hope to join the investment branch here at CalSTRS.
I didn't pay him to say that.
Hello, everyone. My name is Smriti Tibrewal. I'm an MBA student at UC Davis, and after I hope to work in private equity.
Good morning, everyone. My name is Alfei Chang. I'm a Master of Finance student in UC San Diego, and after graduation, I really love to work in a financial institution. Thank you.
Hi, my name is Kira Lusher. I am an incoming junior at Rice University in Houston, Texas. I'm studying economics, policy studies, and global health technologies. And I am here at CalSTRS on behalf of Girls Who Invest.
Hi, everybody. My name is Jonathan Balgos. I attended Consumnes River Community College, and I'll be transferring to Sacramento State University. I'm studying economics, and I want to be an economics teacher.
Hello, my name is Ruben Gonzalez. I'm a senior at California State University, Sacramento, studying finance and accounting, and my goals is to study for the CFA. And I'll pass it on to the birthday boy.
Your birthday?
It's my birthday.
Happy birthday.
Hello, everyone. My name is Joshua Wright. I just recently graduated from the Santa Rosa Junior College, and I am transferring to UC Davis with a pursuit of a bachelor's in economics, and I'm hoping to come back and work in RMS or risk and innovations.
Hi, everybody. My name is Jason Edwards. I'm a rising junior at UC Santa Barbara. Produces great people, obviously. I'm a financial mathematics and statistics major, and for future plans, I'm somewhere between wanting to be an astronaut and then the next CIO of CalSTRS. So.
And you are a student from Priya.
Priya, yeah.
Which you have to say the initials.
The Pension Real Estate Association.
Oh, cool.
So, yeah.
Thank you. The students, boy, do they light up our summer. They're just awesome. And it has been a lot of fun to have them. They always challenge us. And as you can see, our goal every year, so you know, is to have 2 students from the MBA programs or master programs, 2 coming from the community colleges, and then the rest undergrads. And so far, we're starting to see some success where at least 1 or 2 from every class is applying and winning jobs back here. So it's a thrill to see that we're filling the pipeline. So after that, I'm open to any questions. Oh, the admin team. Thank you. You're right, Deborah. The student program would not happen at all without our powerful administration team. So I'm going to ask Sandra Teague and her team to stand up to be recognized. We have to start this recruitment in January because the students start getting their jobs lined up in February. But we work with the UC Davis MBA program and Sac State's Investment Club and Business and Economics Club. And they put it all together. They keep the students in line and just do an awesome job. So thank you to Sandra and Morgan and the entire team. Now we'll open it to questions.
There are no questions, so we're going to move on. I do want to acknowledge and thanks for introducing April Wilcox's team earlier, student interns. My perception is the financial service industry is often more reflective of people that look like me. And it's been openly criticized, a lot of debates about how do you get more women and people of color involved in the financial services industry. And maybe it's the school teacher in me, but I'm extremely proud of the diversity of our team and the young people that are working as student interns here at CalSTRS. It speaks volumes about who we are, and behind each one of those young people are moms and dads. There's a family behind you that are extremely proud of where you are in your life's journey. So we wish you continued good luck, and just remember, there is no substitute for hard work. So keep up the good work. We're proud of you, and we look forward to hearing about your successes in the future. Thank you.